we have gotten to a point where the debt spiral, the total global debt, and I won't just focus on the United States. It's not in isolation. The interest expense makes the debt expand. The only way of solving that is by printing.
Hey guys, welcome back to Library of Wealth. Today we have Bitcoin bull Greg Foss discussing the massive debt spiral we're seeing, as well as the Fed's recent policy on inflation, and how Bitcoin will be a great alternative to solve this crisis. Foss also highlights the debasing nature of fiat currency and says the outcome of the Federal Reserve is dependent on the strength or weakness of the US dollar against other global currencies. The Fed also plays a big role in the direction of markets and assets, and Foss notes that a weakening US dollar leads to a rally in risk assets like Bitcoin and gold. There is also significant concern that the Federal Reserve may face pressure from rising inflation due to the strengthening of imported commodities. With the current state of global debt and the actions being taken by the Federal Reserve to address it, Foss believes the only solution to the runaway debt spiral is through infinite quantitative easing, and that the Fed will eventually have to admit to this. Let's check out this interview with Greg Foss, as he talks about what's coming to the stock and crypto market in 2023 and how the Fed will play a massive role. Don't forget to hit the like button and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
I am not bullish on the US bank system. In fact, I just sent out a tweet and ran some quick math on PacWest. PacWest has a market cap of less than 700 million right now.
Right.
It's got $44 billion of loans outstanding, assets. So you can calculate what that leverage is. It's about 63 times, okay, to its market cap. It's levered 63 times to its market cap. That basically means assets, if they change by more than 2% or 2 out of $100, it's over. It's already over for PacWest. Just based on economic indicators and the like, and the high likelihood that we will see some sort of credit contagion. I believe that at least one rate cut by December. So I'm hedging my bets quite a bit, but a lot of people say no rate cuts all year. I'm on the other side of that. I think there'll be a nominal rate cut and QE infinity. That's the more important thing, is that they open up the printing press again. We have gotten to a point where the debt spiral, the total global debt, and I won't just focus on the United States. It's not in isolation. The total global debt numbers are so large that the organic growth of the debt, because of the coupon, will exceed the will exceed the growth of global GDP to an extent that the interest expense makes the debt expand. The only way of solving that is by printing. There's lots of ways of the terminology, but all fiats debase, Paul. That is just the math, and they are relative. So they're all debasing, just the rate of decay is different between certain nations, depending on things like, obviously, interest rates and trade deficits. But they're all debasing. So we know that for sure. Some are debasing faster than others to enhance their competitiveness in a global market. It's called beggar thy neighbor. If you debase your currency more quickly, the currency makes your exports more attractive. And as you know, GDP is measured as follows. GDP equals consumption plus investment plus government spending plus net exports. So that net exports, well, it's a term that they can play with a debasement of the currency, makes their exports more attractive. That being said, a CBDC is nothing more than a digital fiat. So if you're doing it with analog fiat, you're going to do it with digital fiat. Now, the digital fiat comes with an added bonus of surveillance and monitoring. And, oh, Mr. Foss, you spent your money on at a restaurant on a parade route that we don't agree with. So you were obviously attending that parade. We're going to censor your CBDC. Or let's take it to another extreme. Mr. Foss, you're a fat man. You're a fatso. We are going to limit your caloric intake because we've seen that you're shopping too much at a restaurant. All of these things are possible. Let's not go there. The reality is, though, whether it's an analog fiat or a digital fiat, they're all going down. I mean, let's not overthink things. Interest rates have been on a one-way decline. not for the last 14 years, but for the last 40 years. When I started trading in the late 80s, interest rates were double digits, okay?
Yep.
And essentially they've gone down, and when they go down, bond prices go up. As you know, that's the price interest relationship in bonds. When the Bank for International Settlements created in the late 80s, early 90s, primarily, I guess, early 90s, the Bank for International Settlements capital guidelines, they were focused solely on credit risk, okay? Interest rate risk was not a huge focus for them. Banks are viewed to be lenders, and the largest risk in lending is credit risk, not interest rate risk, because most loans don't have the duration of long-dated treasury bonds. But you see, Paul, in that, long-dated treasury bonds had a capital requirement of 0, which means a bank could take your deposits and essentially lend to the U.S. Treasury, short-term deposits lending to 30-year treasury bonds. As long as interest rates go down, that 30-year bond goes up in price. Everything's hunky-dory until interest rates go up and that bond price goes down. And that's what we're living through right now. So correct, they haven't measured for it from a capital allocation. Doesn't mean that risk didn't exist. It's just that the regulators were focused on other things. And by the way, they barely had enough capital to cover their credit risk exposure. The regulators didn't want to bring in interest rate risk exposure. It would have required all the banks to go out and raise more equity capital, dilute their shareholders, and cause, ceiling on bank stocks. That was not their goal. The capital guidelines were largely, and I worked on the capital guidelines for Canada's largest bank, Royal Bank of Canada, in the early 90s. They were reverse engineered. The banks had a certain amount of capital, and the BIS regulator said, well, let's reverse engineer these credit guidelines so that you already keep the amount of capital that's on the bank's balance sheet. It's such a goofy system. It really is pathetic. And it was largely a response to the Latin American debt crisis in the late 80s that they brought these BIS capital guidelines in. Guess what? Now we're living the regional banking crisis, same problem.
Right.
Though their equity capital has been carved because of interest rate risk, and we haven't even started contemplating the impacts of commercial real estate and real credit risk. It's not good.
One of the most important points Foss mentions is the importance of considering Bitcoin as an investment, as it may provide a hedge against the debasing of fiat currency. He argues that the current situation is unique in history, and the solution cannot be compared to previous periods. Greg believes that the Federal Reserve is lying about the true state of inflation, and soon the definition of inflation will be redefined to downplay its impact by the Fed. He encourages people to challenge the authorities and understand the mathematics behind it. What do you think about this interview with Greg Foss, and what we can expect next with Bitcoin, the crypto market, and the Fed's impact on inflation? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.